If you look at satellite tracking systems over the Pacific Ocean, you'll see a steady stream of cargo vessels moving towards Asia. This isn't a military maneuver. It's a routine part of global food trade. But this movement could be signaling a major economic transition. If there's a noticeable change in the pattern of wheat exports from North America to Asia, its impact won't just be felt in trade statistics. It could ripple from grocery store shelves all the way to geopolitics. For a long time, the United States and Canada have operated as a deeply integrated agricultural system. The Canadian Prairie region is globally renowned for its high-protein wheat, while the U.S. Midwest holds a strong position in processing, milling, and value-added food production. These two economies created a kind of shared ecosystem through the constant cross-border flow of grain. Grain would move north for processing or south for blending. The supply chain was flexible, efficient, and predictable. But global trade isn't just regional anymore. It has become multipolar. In Asia, Europe, and Latin America, demand and sourcing strategies are diversifying. When a country announces a change in agricultural tariffs or policies, the ripple effect is felt instantly across the global market. Wheat is a globally traded commodity, and its price on the futures market reacts minute by minute. If a major exporter redirects a significant portion of its supply to another market, it can cause a temporary shock to the supply-demand balance. The Chicago futures market has historically been highly sensitive to weather updates, export data, and policy announcements. Traders aren't interested in political identities. They are interested in supply stability. When there's uncertainty, price volatility increases. It's a simple equation for them. Uncertainty equals risk, and risk has a price. This is why a subtle shift in trade flows can cause such a stir in financial markets long before it affects the physical supply of grain. China, for its part, follows a highly strategic, long-term approach to food security. To sustain its massive population, it needs diversified sourcing, multi-year contracts, and robust state reserves. So, if Canada were to sign a long-term wheat supply agreement with China, it wouldn't be a purely political reaction. It would also be a sophisticated risk management strategy. For Canada, it's about market diversification. For China, it's about supply assurance. These types of agreements are rarely short-term arrangements. They require extensive planning involving port logistics, rail allocations, insurance arrangements, and long-term export infrastructure development. If the export orientation of a major supplier like Canada gradually becomes more west-facing, toward the Pacific, the integrated North American flow will need to adjust. This isn't an abrupt collapse, it's an indication of a structural shift. It signals that the old, comfortable patterns are evolving to meet new global realities. The American milling industry has historically relied on Canadian high-protein wheat for blending to create specific types of flour. If this sourcing pattern changes, mills will have to find alternative sources, which will likely come with cost adjustments. Production efficiency might be impacted in the short term as they recalibrate their operations, but in the long term, the market will adapt. Modern supply chains are resilient, but adaptation takes time and investment. So, what are the possible outcomes of this shifting landscape? There are three main scenarios. The first is escalation, where retaliatory tariffs could further reduce cross-border trade, creating a more fragmented market. The second is negotiated stabilization, where behind-the-scenes diplomatic dialogues work to restore the trade balance and find a new equilibrium. The third, and perhaps most likely, is a gradual global realignment. In this scenario, nations everywhere learn from this and actively reduce their dependency on single suppliers, embracing a more diversified, multi-market approach. What does this mean for you, the consumer? In the short term, volatility in the grain markets could lead to slight movements in the price of flour, bread, and other grain-based products. However, it's important to remember that the global agricultural production capacity is immense. Australia, Europe, and South America all have alternative sourcing options. So, this isn't a scenario of immediate shortages. Instead, it's a price discovery, an adjustment phase as the global system finds its new balance. This entire situation teaches us a very important lesson. Global trade is deeply interconnected. A single policy shift in one country can create ripples that travel from continent to continent. Food trade isn't just an agricultural issue, it's a critical component of strategic stability. The nations that can diversify their markets and supply chains are the ones that reduce their risk. The countries that lessen their overdependence on any single partner gain leverage in negotiations and secure their own future. The North American agricultural partnership has been a pillar of stability for decades. If it evolves, it's not necessarily a collapse, it's a transformation. The global economy is not static. Power balances shift gradually, and supply chains adapt to those shifts. From the vast wheat fields to the busy shipping lanes, what's happening now is quietly being reflected on the new economic map of the world. Ultimately, The big question remains, are we observing a temporary adjustment? Or is this the beginning of a long-term restructuring of global food trade? For now, markets, policymakers, and consumers are all watching this transition phase unfold. The story of wheat is a story of our interconnected world, constantly changing and adapting. Thanks for watching, and if you found this insightful, don't forget to like and subscribe for more deep dives into the forces shaping our world.